Jeremy Siegel is professor of finance at the University of Pennsylvania's Wharton School of Business. He's also the author of Stocks for the Long Run, and he called the market bottom in March of 2009, among many other things. We really appreciate having him on. Jeremy, thanks for joining us. Let's talk a little bit about our conversation during the commercial break here. You think we could be in a little bit of a correction?
Yeah, I don't think this is going to be more than 5%. I mean, the key here is oil. I mean, we import 12 million barrels a day. We are hostage to the price of oil. But, you know, unless there's a major disturbance in Saudi Arabia, I don't see oil moving up. Today might have been the blow-off high that we will see.
All right, interesting stuff. Jeremy, sit tight for a second. We'll come back in a moment. Let's just walk everybody through the closing bell numbers on this Thursday, February 24th. Well off our lows. In fact, we're pretty much finishing at our best levels of the session. What does that mean? Well, it means little changed here at the close for the S&P 500. Still down 3 days in a row. 1306 is your trade on the S&P. Light volume, though, on this Thursday. Check out the Dow Jones Industrial Average. It, too, finishing with a slight loss, just down about 1/3% there at 12,068. The NASDAQ, though, holding on to some gains, as we saw gains really throughout the session today. 2737, just up about 15 points. Good for a gain of about 0.5%. Right now, we want to head out to Chicago, bring in John Brady. He's Senior Vice President at MF Global. He's at the CME Group out there in the Midwest. So, John, we're well off our lows here. Kind of a bit of a mellow day, it actually felt like, when all was said and done.
Well, Carol, I think for the last couple of sessions or so, managers have sort of pared back risk a little bit and are only expressing strong views if they absolutely have to. You know, the situation in the Middle East remains rather fluid. The economic data has been rather mixed. A drop in claims and jobless claims now have a 3 handle. However, the durable goods numbers were sort of tough to get through. And then, of course, you add in what's going on in the Middle East, perhaps an increased chance of a hard landing in China. And I think asset managers are sort of staying on the sidelines, waiting to see how things develop over the course of perhaps the next few sessions, maybe in the next week, before they have a little more clarity, a little bit more conviction before putting money to work.
Jeremy, would you sit on the sidelines right now, or would you see a little bit of this pullback, an opportunity to get in even more aggressively?
Yeah, I think this is an opportunity. And we've had these dips before in this bull run. And, you know, as I say, I think this run has some distance to go. I wouldn't, you know, I'm calling for 1,400 on the S&P by late in the year. I won't be surprised if it's above that. Again, I don't think there's going to be a major disruption in oil that's going to really, you know, kill the economy. And it is a buying opportunity, I think, for investors.
You know what? I want to talk about energy's effect here on retail. And Julia, I know you've been looking into this. People fret about the jump in energy prices, especially people who want to sell you other stuff. But you're saying maybe it's not all that bad for retail.
Well, the analysts over at Oppenheimer are actually looking at this question and saying, you know, with the drop that we've seen in retail stocks this week is maybe overdone, because if you look at past times when you've seen increases in gasoline prices, it hasn't necessarily meant that retail sales have pulled back dramatically. And if you look here at this chart, you don't really necessarily see a correlation. In fact, especially on the far right of your screen, you see retail sales coming up at the same time that the average gasoline price is going up. So basically, the analysts say any short-lived move up in oil and gas prices should have an only minor, if any, impact upon sales at most chains here. There's not necessarily this direct one-to-one comparison where I'm paying more at the pump and that means I'm going to spend less on that sweater that I'm buying, or I'm not going to buy it at all. And so I would throw this out to you guys. I mean, Jeremy, when you're looking at consumer spending, not necessarily this one-to-one comparison, but how important is a higher gasoline price for sentiment and for spending?
Well, everyone talks about it, and it is a factor that affects consumer sentiment. But I was recently in Europe and in Germany, where everything's booming, and they pay $8 to $9 a gallon for oil. They seem to be surviving. You know, we've been hooked on pretty cheap energy, and that's why it makes so many headlines. But, you know, we're much stronger. The last time that we had the surge, 2008, we were going into a recession. We were already in, according to the NBER. Here, we're definitely out of the recession. We can withstand another 20, 30, 40 cents, and I don't even think it's going to be that much.
All right, we're definitely hooked on energy. And, Adam, it looks like some rich investors are kind of hooked on those big cap names.
Yeah, they sure are. And perhaps it's because they're cheaper. At least that's what Jeremy Grantham says. He's the guy behind GMO, huge money management firm up in Boston. They manage, gosh, $105 billion, let's say. Well, take a look at the PE ratios for the S&P 500 and then the small caps, the IWM. It's 14.1 times for the S&P, 30 times for the Russell small caps. The point is, obviously, they're a lot cheaper. You've seen money flow over the past month into some of the large cap mutual funds. As a matter of fact, about a $5.2 billion inflow versus December was a $13 billion outflow. So I guess the question, Jeremy Siegel, is are you buying into this large cap argument where maybe that's where you want to be because they're safest and the most predictable in very uncertain times?
Well, when you can buy, as you said, 13 to 14 PE in an environment of still extraordinarily low interest rates where the dividend payers are yielding 3-4% better than the Treasury bonds, I think that is safety. I think that is a conservative investment in today's environment.
Hey, Jeremy, let me ask you and John really about something that could trip up the U.S. equity markets, and that is interest rate increases. Jeremy, you have said before that you are concerned that maybe the Fed won't be ahead of the curve here when they need to start raising rates. Do you think that they're on track right now?
Well, it's too early to say. I mean, QE2 is supposed to, expire in June. We think it will. There's a lot going to go on between now and then. But what investors should also realize in the early stages of Fed tightening and raising interest rates, that has not historically been bad for the stock market. It's only the very late stages. So we're not there yet where I think investors have to worry, stock investors have to worry about rising interest rates.
Well, and the banks have already made $1 gazillion. They arguably don't need the help anymore. Do we see interest rates rise this year?
I think we do. I think by the late summer and fall, the Fed is going to be thinking of raising that Fed funds rate from the 0 level that we've had the last 2 years, most definitely.
John, you're trading rates all day. What do you think?
I think that's right. The fear I have is this. I think in the coming months, we're going to see some pretty strong employment numbers. And by June, it will seem pretty clear that QE2 has sort of run its course. The fear, of course, we have is that, of course, there's some type of dollar crisis and there's a reassessment of credit risk to U.S. Treasuries and perhaps other government bond markets. And that, of course, could force the Fed's hand a little bit sooner and quicker. But I think for the most part, I think there will be a desire by the Fed by the end of the year to at least begin to normalize interest rate policy, perhaps lift the funds rate maybe to 50 basis points and begin that process. But they do have a comfort in being slower than they otherwise would be because we still have an output gap and inflation pressure should be muted given the lack of income and wage growth that we've seen here in the last year or two.
Hey, guys, hang on for a second. We did get some earnings out just a moment ago. Applied Materials. And, Adam, it looks like a beat on both the top and the bottom lines here.
Yeah, they sure did. On the top line, the sales number came in $2.69 billion. The expectation was $2.59. So they got more money coming in. That's key. And then on the earnings number, they beat even the whisper number. They come in at 36 cents. The official number was 32. The whisper was 35. So no matter how you slice it, but you can see the stock is trading down. As soon as the numbers crossed, the stock was up about 1%. Right now, it's trading down. The call is going to be about a half hour. And what you really want to focus on is the new orders that are coming in. A lot of the analysts have upped their numbers because of CapEx spending. In other words, companies going out and spending more money. That should translate into new orders. We're going to get the detail in the conference call again in about 20 minutes.
And I just want to remind everybody, Gap earnings also came out. Their EPS number also beat here by 3 cents a share. They are, though, reining in their year EPS estimate somewhat. And they also are going to buy back an additional $2 billion worth of share. They're also boosting their quarterly dividend to 11.25 cents a share from 10 cents a share. Well, looks like you wanted to add something.
Well, no, because Julie has a takeaway also on AMAT as well as, I'm sure, the Gap. Jules?
Well, I just wanted to point out, if you're looking at Applied Materials, one of the things that might account for some of the disappointment here is the gross margins in the first quarter, coming in at about 42.3%. The estimate was 43%. So those gross margins, when you're talking about tech companies in particular, are something that investors pay attention to. That could account for some of the pullback that we're seeing in that stock.
You know, Jeremy, last time we talked with you, Matt and myself, back in January, you said, watch those earnings very closely. You were really comfortable. You thought it was a great price ratio when you looked at the S&P 500. Still feel that way?
I still did. I mean, you know, we still had over 70% of the S&P firms beat their estimates. Actually, even though there's been some very recent revenue disappointments, we had the highest fraction beating revenue in the last 3 years. So there was definitely good news, but it's not going to be as easy with past comparisons going through 2011 as it has been going through 2010 off the recession year.
All right. Hey, Jeremy, thanks so much for joining us. Jeremy Siegel there from Wharton. We want to thank John Brady as well, joining us out of Chicago.